So in our previous discussion, we talked about the balance sheet. As a little bit of review, the balance sheet covers the assets, liabilities, and the owner's equity at a very specific point in time, at the end of the company's fiscal year. Now, when we look at the income statement, it does not cover a point in time. What it really does, it covers a period of time. In this case, it covers the year ended December 31, 2017. So what this is really telling you is it's giving you the operational performance of this company for these 365 days. January 1, beginning of the year, all the way through the end of the year. And what I'd like to point out with this is that it's really called a change statement, okay? So because it's covering that period of time. It's really the operational performance. Now it could be for a month, could be for a quarter. You could theoretically even make an income statement for a day or a week, although most companies wouldn't do that. But the point to take away is that it covers a period in time. And it would not be sufficient if we said, for example, the period ended December 31, 2017. That would not be a sufficient title. And here's why. That doesn't tell you if it's simply for the month of December or for the fourth quarter of 2017. It's a little bit ambiguous. So what we need to do is we need to really indicate this is for an entire year. You could say for the 12 months ended December 31, 2017 if you wanted to. Now let's look at the elements. The revenue portion here, revenues are what you are earning from your customers. So you can almost think about this as being the good stuff, right? So it's a coffee shop, we sell food and beverage. Now, there's nothing magical about these particular categories. I chose to put food and beverage there because that's what a coffee shop would sell. Now, if they wanted to combine those, I suppose they could. If they have other sources of revenue, maybe they deliver, so there would be delivery fees. That's one possible source of revenue. What's happening here is that whatever revenue categories are here, they're aggregated at a high level to a level of detail that is sufficiently appropriate. So it's meaningful to the readers of the financial statements. What you want to keep in mind is that financial accounting involves giving information to external parties, people who are outside of the company. And so a lot of times these financial statements are aggregated. There might be more than 2 general ledger accounts for sales revenue, but we have aggregated those to a level that's meaningful for external users. Now, you've probably heard the adage, you have to spend money to make money. So what we see here, these are the total expenses of the company. These are things that we had to purchase. They are expenses we had to incur. They are the costs of running our business. So you can see cost of goods sold as an example. This would be the cost of the ingredients for the food and the beverage. It would probably also include the cost of labor for serving and preparing those beverages. These are costs that are very closely related to the generation of revenue, and they can be expected to approximately fluctuate with revenue. In other words, if revenue decreases, we would expect that cost of goods sold should also decrease. It may not be a completely linear relationship, but they should at least change in the same direction. Now, we have other expenses, and just like with the revenues, there's nothing magical about these categories. What you want to do is you want to make sure that they're sufficiently aggregated to a level that's meaningful for the users of the financial statements. When they read these financial statements, they should be able to draw conclusions about those various elements. Now, the last thing I want to point out is that the revenues minus the expenses ultimately are your net income. In this case, I cut it off a little bit there, but $163,000. So that is essentially the profit or the earnings of the company for this particular time period. And finally, this is what's called a single-step income statement. I'm using that for kind of a beginning illustration of the income statement. What you're going to see as we expand our study is that really most businesses use what's called a multi-step or multiple step income statement. multi-step and single step, they will arrive at the same bottom line net income, but the journey toward net income will look a little bit differently. We're going to have some different subtotals like gross profit and operating income. So I just kind of want to warn you, if I could say that this is really a simplified version of the income statement, but hopefully it has given you a little bit of insight into what information is conveyed by this statement.